welcome to another episode of Full Court Finance here at Zacks. Today we're taking a look at two long-term tech stock deals to consider as we get deeper into August, and those two names are Jabil and Netflix. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two tech stocks to consider buying, I want to take just a brief recap of where we are in the market, just to give a better context of what's going on with these two names and why they might be worth looking at. So July marked the fifth straight monthly gains for the S&P 500 and the NASDAQ. So that big midweek selling we saw on Wednesday was hardly shocking, and it kind of makes sense to help cool things down. Some of the slide was attributed to that the downgrade of U.S. government credit rating, but then we saw people like JP Morgan CEO Jamie Dimon point out that it doesn't really matter and the market decides that. He went on a CNBC interview saying the U.S. credit is sound and it should be the highest rate in the world. So take that for what it will. Meanwhile, though, the yield on 10-year U.S. Treasuries continues to climb as investors are realizing that the Fed might have to keep its rates higher for longer in order to tackle inflation and, most of all, prevent it from rebounding. So we saw that ADP jobs report come in ultra hot again for July, but remember that figure came in really hot for June as well, and people paid far more attention to that non-farm payroll, which that data came out on Friday morning. So we saw the U.S. economy at about 187,000 jobs last month, which came in slightly below the 200K estimate and below June's 209,000 as well, with unemployment slipping to 3.5%. So still the job market's pretty strong, which is why you're starting to see more investors realize that the Fed not going to be able to probably lower rates as soon as they would have hoped, but they might not have to raise them either. Just keep them there for an extended period of time. So outside of the jobs market, Wall Street's been fixated on the jam-packed earnings season. We saw Apple and Amazon report last night, and we've seen a lot of selling or heavy buying, so big swings on lots of reports from names that are big names and non-household names as well. So just huge moves from lots of these reports, which makes sense. So we've seen some profit taking over the last month, and we might not be done seeing that profit taking over the next several weeks as people use earnings to either lock in profits or send some of these stocks even higher. With that in mind, the NASDAQ slipped below its 21-day moving average earlier this week after that big midweek fall with that 2.2% fall, which was its worst since February. It remains well above that 50-day, and we also saw the S&P 500 close slightly below the 21-day moving average on Thursday. But things were looking a little worse on Friday morning, but then all of a sudden we saw the bulls step in, and they're trying to take the NASDAQ and the S&P 500 right above that 21-day moving average. The last time I looked, the NASDAQ was up about 1%, and the S&P 500 was up about 0.6%. So seeing buyers step back in right at those levels. So that's good to see if you're bullish on stocks that investors are willing to hold that line and try to keep the train moving forward. So with this in mind, we're going to take a look at the first of these two tech stocks, and that is Jabil, which trades in the ticker JBL. The company provides manufacturing services to companies in telecommunications and tons of other industries. The firm's client list includes the likes of Apple, SolarEdge, and tons of other giants in critical and game-changing areas. They help make everything from smartphones and home appliances to healthcare tech and far beyond. So it serves original equipment manufacturers, product companies across multiple industries and end markets. So that its various offerings are for appliances, automotive, healthcare, telecom, industry, or energy, industrial, compute, and storage, and various other areas of the economy. So overall, that diversification and expertise has helped it grow pretty steadily over the last few years, including 12% average growth between fiscal 2018 and fiscal 2022. And it posted 14% sales growth in 2022. So a big year last year. Most recently, the company topped our Q3 FY 2023 estimates in mid-June and provided upbeat guidance once again as it flexes its resilience and showcases just how vital and critical its offerings are during economic booms and cool downs. The positive earnings revisions help it land a Zacks rank number 2 right now, and the recent positivity is part of a longer-term upward trend for the stock in terms of its earnings revisions over the last several years, and that's extending out through 2025 at the moment. So Zacks estimates call for JBL's revenue to climb again this year and next year to boost its adjusted earnings by about 11% and 9% respectively. Its shares have soared about 80% over the last 12 months, and they're up about 60% year to date to easily outpace the Zacks tech sector during both periods. Over the longer period of time, so over the last 10 years, the stock's up about 380% versus the tech sector's 260% climb, so big outperformance there. The stock hit new highs in the middle of July, with it trading about 5% below those levels as of Friday morning. And despite that long-term and recent outperformance, the stock is trading at a 50% discount to the Zacks tech sector at 12.7 times forward 12-month earnings, so solid value there. And maybe more importantly, it also marks a 31% discount to its own 10-year highs and only a slight premium to its median over the stretch. This is despite climbing 360% over the last decade and about 80% over the last 12 months and trading only about 5% off its recent all-time highs. The company also pays a small dividend at the moment with a tiny payout ratio, so that offers plenty of long-term upside. And we should remember that Jabil is set to benefit from the broader onshoring/reshoring from the U.S. government and U.S. companies to try to manufacture more critical technology here in the United States. And 5 out of the 6 brokerage recommendations that Zacks has for the stock are currently strong buys. And now we're going to go ahead and take a look at a probably much more well-known name that's been in the news recently more for some of the Hollywood strike-related issues, and that is Netflix, which trades on the ticker NFLX. The stock has skyrocketed around 160% off its lows as investors continue to buy Netflix and other beaten down tech giants at attractive levels. So even though the company has bounced back in a huge way alongside the likes of Meta and others, it still has miles of runway before it returns to its 2021 peaks. So obviously we're just going to kind of roll through a little bit of Netflix. Netflix kind of was the streaming TV pioneer, and it revolutionized the way that we're consuming TV today. The company's rise to Wall Street superstardom occurred as it rapidly racked up millions of subscribers around the world and in the US, and kind of completely changed the wider TV and movie industry landscape seemingly forever. The company's success has had everyone in the business, from Disney to Apple to Amazon to NBC to everybody else, try to get into the streaming business, which they now are all in. So obviously there's lots of competition, and its huge days of massive top line growth are likely over as it reaches certain levels of saturation in markets like the US and beyond. So we saw its 2022 revenue climb about 7% versus around 19% growth in 2021 and about 24% growth in 2020. That's a natural slowdown, though, and that's why it's rolling out an ad-based tier, and it's experimenting with its paid sharing offerings, so people aren't allowed to just share their account with tons of people anymore. It's also recently restructuring its advertising partnership with Microsoft that it rolled out to try to lower ad prices in a bid to kind of jumpstart that new area of its business model. So in May, the company said, and this is terms of the paid sharing, it said it successfully launched paid sharing in 100 plus countries, representing about 80% of its revenue base. The firm said when it reported earnings on July 19th that its revenue in each region is now higher than pre-launch, with signups recently exceeding cancellations. So that's positive in terms of that paid sharing, which people have been talking about a lot recently. And Netflix posted a surprise about 5.89 million jump in subscribers in that June quarter. So the quarter reported in the middle of July. Netflix is still the largest streamer now, so it's boasting about 283 million paid memberships. This blows away Disney Plus's 158 million, and Disney's actually seen some subscriber losses recently. The company beat our Q2 earnings and revenue estimates on the back of that nice Q2 user gain. So looking ahead, we're calling for another about 7% growth this year on the top line. So to do about the same growth they did last year, pretty impressive. And then we're calling for another 14% revenue growth next year in 2024 to get it up to about $38.5 billion And then on the bottom line, we're calling for about 20% adjusted earnings growth this year and then another 32% next year. So some solid top and bottom line growth as the company reaches a more mature, stable business. So these up, and it's seen some positive upward earnings revisions since that last release for the current year and for 2024, which is solid. So those upward revisions help Netflix land a Zacks ranked #1 strong buy right now. The company is continuing to invest, obviously, in a variety of original content in the U.S. and globally to keep and attract new subscribers in this bid to make sure that they don't lose out to all of the new players in the industry. We should note that the company said when it released its results in July that per Nielsen, last quarter in the first half of 2023, it had the top original streaming series in the U.S. for 24 of the first 25 weeks of 2023 and the top movie for 21 weeks. So it is doing well despite all of the competition. And as I said, it still is the biggest streamer in terms of memberships. Overall, the stock's up about 90% in the last year and 45% year to date. And despite that rebound, it's still trading about 40% below its peaks. So that's a positive sign. And right now it's trading right in between its 50-day and its 21-day moving average. It got rejected by its 21-day not that long ago, but now it's trying to get right back up at those levels. And if we look at the valuation front, it's trading at a roughly 60% discount to its 10-year median at around 30 times forward earnings, around 31 times forward earnings, 30.7 to be exact. And in fact, it's now trading at levels that it was back in 2010, 2009. And obviously, it's no longer forecasting its subscriber growth going forward. So that used to be how the stock traded at all times was, did it beat or miss its subscriber growth? So that shows that it's really changing its business model. It's not only focused on this massive growth. So that's why they're trying to do other things like the paid ad tier and paid sharing and all of those things. Obviously, Wall Street wants to see the company continue to act like a more mature company, improving its balance sheet, cash flows, margins, things like that, while still pursuing fresh growth. Obviously, some people might be a little nervous about getting involved in the Hollywood strike or getting involved in Netflix amid the Hollywood strike. I'm not going to get into all of that. I'm assuming that a deal is going to get done at some point. I can't imagine that Hollywood is just going to shut down for a very, very extended period of time. Obviously, some people that might scare them away for now, but Netflix isn't going anywhere. And even if the strike lasts a little bit longer, people are still going to be watching Netflix because there's going to be less new content coming out. But overall, streaming is the future, and Netflix is still one of the dominant players, even though all of these other businesses have joined the race over the last few years. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.